I want to talk about maybe my favorite strategy for New Yorkers to be able to take advantage of a little bit of arbitrage in the tax code. So within the New York State tax return, line 29, there's a retirement age exemption on the first 20 grand of retirement income. So that can be IRA distributions, 401k distributions, annuities, pensions, but you qualify starting at age 59 and a half. That doesn't mean you have to be done working, it just means you have to be 59 and a half, and that's where this pocket opens up. So let me point out where this can come into play. Say you take a distribution from your IRA, you're going to have to pay taxes on that, right? So they'll increase your taxable income by $8,000 to the feds, and because you qualify for that line 29 exemption, $0 to New York State, which is pretty nice. If you then took those dollars, put them directly back into that IRA, you generate a deduction of $8,000 to the IRS and $8,000 deduction on your New York State tax return. So you probably noticed here, those cancel out, and what you've generated is an $8,000 New York State tax deduction without increasing your tax liability anywhere. You took it out, you put it right back in the exact same account or a different IRA. As long as it's a deductible IRA, you're generating this tax arbitrage, a pretty beautiful opportunity. There are some key points here. So I mentioned you have to be 59 and a half. That's really important. You also have to have wages. You have to have sweat of the brow wages. It can't be just distributions from a retirement account. It has to be that you're still working. And the last part is that you have to have earned income that's below certain limits. So if you're covered by an employer plan, that limit is $129,000 of taxable income. Or if you're the spouse of someone covered by a retirement plan, that moves up to $242,000. So this I tend to see when people are having a split year. So you can be in a spot where you're saying, well, I was earning over that, but I only worked 6 months. Beautiful, let's take advantage of that. Or more commonly, I see when a couple will choose to stagger retirement, jumping up to $242,000 of wages is a pretty big jump. So we can see pockets that open up. We say, you know, husband retired, wife is still working. Maybe they're able to take advantage of that and do the spousal IRA off that spouse's income and generate themselves a nice little tax deduction. Or if you both qualify, move this to $16,000 instead of just $8,000, just doubles that tax impact. Pretty meaningful, pretty huge opportunity to save some taxes without really adding any risk to your life, which is a pretty nice maneuver.